FAR.F3.M4.
Welcome back. Today we're talking about PP&E cost basis, and Jenna, this sounds like one of those topics that's just a giant shopping list of costs to memorize.
That's exactly how a lot of candidates approach it, Russell, and that's why they struggle. This module isn't really about memorizing lists. It's about answering one question over and over. What did it take to get this asset ready for its intended use? If you can answer that question, most of the module falls into place.
So every exam question is basically asking what belongs in the price tag.
Exactly. Historical cost isn't just the invoice from the seller. It's everything necessary to acquire the asset and prepare it for use. The Becker module starts there, because everything else builds from that foundation.
That already feels simpler. Instead of 50 rules, I have one guiding principle.
And then we'll learn the exceptions and special applications.
Let's start with the big picture. What exactly counts as property, plant, and equipment?
PP&E consists of long-term assets acquired for use in operations, not for resale. They're physical assets, and they'll generally be depreciated over time. Think land, buildings, equipment, machinery, furniture, fixtures. The balance sheet presents these asset classes separately, along with accumulated depreciation.
So, unlike inventory, we're not planning to sell these.
Right. They're the tools that help the company generate revenue.
I like thinking of a company as opening a bakery. The flour is inventory, the oven is PP&E.
Perfect analogy. The flour is consumed and sold. The oven stays behind, helping produce bread for years.
Now, historical cost. That's where people start making mistakes.
Yes. Historical cost equals everything necessary to obtain the asset and get it ready to perform its intended job. Notice those last few words. Ready for its intended use. They're going to matter over and over today.
Let's talk about land because Becker spends quite a bit of time listing costs.
Land has one major characteristic. Land itself is not depreciated. Because of that, it's important to determine what belongs in the land account. Purchase price obviously belongs there. Broker commissions, title fees, legal fees, recording fees, costs to clear the land, costs to drain swamps, grading and site development, removing an old building, even property taxes owed by the previous owner that the buyer pays as part of acquiring the property. The common thread is simple. Did this expenditure make the land ready for its intended purpose?
Here's my analogy. Imagine buying a vacant lot to build your dream house. Everything you have to do before you can even start building becomes part of the land's cost. It's like preparing the stage before the actors arrive.
That's a really helpful analogy. Just remember where it breaks down. Once you begin creating the building itself, you've switched from preparing land to constructing another asset. The costs stop belonging to land and begin belonging elsewhere.
Which brings us to land improvements. This always sounded like land.
And that's why candidates confuse it. Land improvements are separate because they wear out. Things like fences, lighting, parking lots, sidewalks, landscaping, water systems. Those all have finite, useful lives. So unlike land itself, they're depreciated.
So if something eventually wears out, there's a good chance it shouldn't live inside the land account.
Exactly. Think permanent versus depreciable. Land is permanent. Improvements eventually need replacing.
Now buildings. What's different?
Buildings include the purchase price plus everything necessary to acquire and prepare the building for use. Architect fees. Certain improvements. Construction period interest when applicable. Repairs neglected by the previous owner before the building is placed into service. Those all become part of the building's cost.
I noticed Becker has a pass key here.
Yes, and it's one students should absolutely remember. When constructing a building, filling a hole belongs to land. Digging a hole for the foundation belongs to the building. It's surprisingly memorable.
It's funny because it sounds almost too simple. Fill the hole, land. Dig the foundation, building.
Exactly. The exam loves distinctions like that because they reveal whether you understand what you're preparing.
Let's move to equipment.
Equipment follows the same historical cost principle. Invoice price, sales tax, freight, insurance during transit, installation, testing, anything required to get that machine operating. Those all become part of equipment.
I keep hearing the same sentence. Ready for intended use.
That's intentional. If you internalize that phrase, you won't need to memorize isolated facts. You'll reason your way through unfamiliar questions.
Now we reach what might be the most tested distinction in this whole module. Capitalize or expense.
Absolutely. Here's the framework. Ask yourself whether the expenditure creates future benefit. If it's simply maintaining existing performance, it's usually an expense. If it improves the asset beyond its previous condition, it's generally capitalized.
Let's separate the categories.
Ordinary repairs keep the asset operating. Oil changes, routine maintenance, minor fixes. Those are expenses. Extraordinary repairs, additions, improvements, and certain replacements extend useful life, increase capacity, or improve usefulness. Those are capitalized.
I picture owning a car. Changing the oil doesn't make the car better than yesterday. It simply keeps it running. That's maintenance. Installing an entirely new engine that dramatically extends its life feels different.
Exactly. That's one of the best everyday analogies. Maintenance preserves. Improvements enhance. The accounting follows the economics.
Now Becker also discusses replacements where the carrying value of the old asset may or may not be known. That's one of those areas people panic over.
Don't panic. Focus on the concept. If the old component's carrying amount is known, remove it and recognize any resulting gain or loss. If it isn't known, Becker explains alternative approaches depending on whether the expenditure extends life or increases usefulness. For listening purposes, the important idea is recognizing that replacing part of an asset isn't always treated like buying an entirely new asset. The accounting depends on what's being replaced and what information is available.
So don't memorize isolated journal entries. Understand why we're making the adjustment.
Exactly. That's much more durable.
Let's talk about basket purchases. These show up pretty regularly.
A basket purchase happens when land and buildings are purchased together for one combined price. The company can't simply guess how much belongs to each asset. Instead, Becker tells us to allocate the purchase price according to the relative appraised values.
So imagine buying a combo meal. You know what you paid overall, but internally you still need to assign value to the burger, fries, and drink.
That's a useful analogy. Just remember, accounting uses appraisal ratios rather than arbitrary estimates. The allocation follows evidence.
Now we arrive at what seems to intimidate almost everybody: capitalized interest.
Mostly because students think it's one giant computation. Conceptually, it's actually straightforward. When a company builds certain qualifying assets, some interest incurred during construction becomes part of the asset's cost instead of immediate expense. Why? Because financing construction is part of getting the asset ready for use.
So we're treating financing almost like another construction cost.
Within limits, yes. And Becker emphasizes two rules that are especially important for the CPA exam. First, capitalize no more interest than you actually incurred. Second, capitalize the lower of actual interest incurred or avoidable interest. Those two rules appear in the passkey for a reason.
That's worth repeating. Lower of actual interest or avoidable interest. Never more than what was actually paid.
Exactly. Whenever candidates get lost in calculations, those two rules usually rescue them.
Now explain weighted average accumulated expenditures without drowning everyone in math.
Think about building a house. You don't spend every dollar on day one. Some money goes out in January, some in April, some in August. Interest shouldn't be calculated as though every dollar was borrowed for the entire year. Weighted average accumulated expenditures estimate how much money was actually tied up during construction over time.
That's much more intuitive. It's measuring how long the money was invested in the project.
Exactly. Time matters. Money spent earlier accumulates interest longer than money spent near completion.
And not every construction project qualifies forever.
Correct. Capitalization begins when expenditures are occurring, activities necessary to prepare the asset are underway, and interest cost is being incurred. It stops when the asset is substantially complete and ready for its intended use. Normal construction delays don't necessarily end capitalization. Intentional delays generally do.
So the stopwatch isn't simply the calendar. It's tied to actual construction activity.
Exactly. You're following the economic reality.
I noticed Becker also says investment income doesn't reduce capitalized interest. That seems counterintuitive.
It surprises many students. For CPA purposes, don't reduce capitalizable interest by income earned on temporarily invested borrowed funds. That's another place where candidates sometimes bring in assumptions that don't match the Becker material.
Let's zoom out. Everything we've discussed seems connected by one idea.
It is. The asset's recorded cost should represent what it truly took to place that asset into service. Nothing more, nothing less. That's why routine maintenance is expensed. That's why construction interest can sometimes be capitalized. That's why installation belongs with equipment. That's why clearing land belongs to land. They're all answering the same question. What did it take to prepare this asset for use?
Here's another analogy. Imagine opening a restaurant. Before opening day, every decision is preparing the restaurant to operate. Buying ovens, installing plumbing, paying architects, clearing the property. Those become part of creating the restaurant. But 6 months later, replacing light bulbs and mopping floors are simply operating the restaurant.
That's probably the best summary of the entire module. Preparation versus operation. Costs of preparation are often capitalized. Costs of operating are generally expensed.
Let's finish with the biggest exam traps.
First, don't confuse land with land improvements. Land isn't depreciated. Land improvements usually are. Second, remember the building pass key. Fill a hole equals land. Dig a foundation equals building. Third, basket purchases use relative appraised values. Fourth, ordinary repairs are expenses. Extraordinary improvements are capitalized. Fifth, understand the purpose behind capitalized interest instead of memorizing formulas. And finally, never forget Becker's 2 capitalized interest limits. Lower of actual interest incurred or avoidable interest. Never exceed actual interest.
I think that's what makes this module satisfying. At first, it feels like random accounting trivia. Then you realize every rule points back to one central question.
Exactly. If listeners leave with only one sentence today, let it be this. Ask yourself, what costs were necessary to acquire this asset and prepare it for its intended use? That single question unlocks almost every major concept in FAR.F3.M4.
And that's one less giant memorization chapter and one more logical accounting framework. I'll take that every time.
Same here. We'll see you in the next module.